The first $10 you lose are rarely the expensive part. The dangerous loss is the belief that the market now owes you a house. That belief can hide inside sensible-looking decisions. You take a small position, it moves against you, and you add more because the price is better. Then you widen the stop because the trade needs room. What began as $10 of controlled risk becomes a test of pride, and pride has no natural limit. There is nothing wrong with starting small. In fact, a small account can teach discipline more honestly than a large one. But $10 is not a house in disguise. It is a measuring instrument. It reveals whether you can wait without inventing opportunities, accept a loss without bargaining, and follow price behavior instead of following your need for money. The market does not reward the size of your ambition. It responds to liquidity, expectations, positioning, and the imbalance between buyers and sellers. If buyers repeatedly fail to push price beyond resistance, that failure matters. If a breakout attracts attention but cannot hold, the reaction matters more than the excitement. Your task is not to predict a grand future from every candle. It is to notice what participants attempted, and whether the market accepted or rejected that attempt. This is where the dream of $10 to own a house becomes useful, but only if you interpret it correctly. The house is not the immediate target of the next trade. It represents a distant outcome built from decisions that survive uncertainty. When the target is too large and the capital too small, the temptation is to force the mathematics with leverage. That may make the possible gain look impressive, but it also turns ordinary market noise into account, ending risk. Watch what happens inside you when the potential profit feels meaningful. Do you enter before confirmation because you fear missing the move? Do you ignore weakening momentum because closing would reduce the imagined reward? Do you increase size after a loss to recover time? These behaviors seem different, yet they come from the same era, allowing the desired destination to dictate the present decision. A disciplined trader reverses that order. First comes the condition: is the market trending, ranging, or behaving erratically? Then the location: is price near a level where buyers or sellers have previously shown commitment? Then the risk if the idea is wrong: where will the market demonstrate it? And can that loss be accepted without financial or emotional damage? Only after those questions does potential reward deserve attention. Consider a hypothetical breakout. Price clears a well-observed level, volume or participation increases, and then price returns to test the level. The impatient trader sees only the house. The careful trader watches whether sellers can drive price back beneath the breakout and keep it there. One is reacting to possibility, the other is studying evidence. A $10 account can be right about direction and still lose money. The market may move exactly as expected, yet the gain never reaches the account. Part of it disappears at entry, another part at exit, and sometimes the entire opportunity is smaller than the cost of taking it. With very small capital, execution is not a minor detail. It is part of the trade itself. Begin with the spread. The chart may display one price, but you buy at the offer and sell at the bid. The distance between those prices is an immediate cost. In a liquid market, that distance may be narrow. In a thin or rapidly moving market, it can widen without warning. If your expected move is small, the spread may consume much of it before the position has had a chance to work. Commissions create a second obstacle. A fee that appears insignificant on a large order can be severe on $10. Suppose, hypothetically, that entering and exiting costs a fixed amount. The market must first move far enough to recover that charge. Only movement beyond that point becomes gross profit. When the cost represents a large percentage of the account, frequent participation becomes mathematically difficult, even when several trades are directionally correct. Then there is slippage, the difference between the price you expect and the price you actually receive. A market order gives priority to execution, not to price. In a fast market, available orders may be taken before yours arrives, leaving you filled at a worse level. Your analysis may have been sound, but the trade you planned and the trade you received are no longer identical. A limit order offers more control over price, but it creates a different problem. It may not fill at all. Price can touch your level briefly, Trade only a small quantity and move away without including your order. A partial fill can be equally awkward when the position is already small. The order type does not remove execution risk, it merely decides which form of risk you are willing to accept. Minimum order sizes also shape what is possible. Some instruments allow fractional positions, while others require fixed contract sizes or minimum quantities. If the smallest permitted position is already too large for the account, the instrument is unsuitable regardless of how attractive the chart appears. The market offers an opportunity, but the account lacks the scale to express that idea with precision. Liquidity must therefore be judged before entry. Look at the typical spread, the depth available near the current price, and how execution changes during quiet periods, major announcements, or sudden volatility. A market can appear active on a chart while offering poor fills at the exact moment you need them. Visible movement is not the same as dependable liquidity. You should also compare total trading cost with the movement you reasonably expect to capture. If spread, commission, and probable slippage consume a large share of that movement, the setup has little room for execution error. This does not make the forecast wrong. It makes the vehicle inefficient. That distinction matters. Analysis asks whether price may move. Execution asks whether you can participate in that movement on workable terms. A trader who studies only direction sees half the transaction. Before placing an order, identify the actual entry price, the likely exit price, every fee, the normal spread, and the minimum tradable size. Observe whether those conditions remain stable when the market accelerates. If the numbers leave too little of the expected move, passing is not a judgment on the market. It is recognition that this particular account and this particular instrument do not fit. Once those costs are placed beside $10, the next question becomes unavoidable. What rate of growth would remain after friction, and what would the arithmetic truly demand to reach the price of a house? $10 can become a larger sum, but arithmetic does not care how badly you want the transformation. It asks only 4 questions. What is the starting capital? What is the required destination? What return can be repeated? And how much time is available? Take a purely hypothetical house price of $100,000. Turning $10 into that amount requires multiplying the account 10,000 times. That is not a 10,000% gain. It is a gain of 999% because the original $10 is already part of the final amount. The difference matters. Large goals often appear closer when percentages are spoken loosely. Another way to view the distance is through doubling. $10 becomes 20, 20 becomes 40, and the process continues. It takes a little more than 13 consecutive doublings to pass $100,000. Each doubling demands the same percentage return, but not the same monetary gain. Moving from 10 to 20 requires $10. Moving from 40 and 960 to an 81 920 requires 4960. The percentage is unchanged, the burden in dollars has become enormous. Compounding is powerful because each gain enlarges the base for the next gain. But the equation works only when profits remain in the account and positive returns continue across many periods. A hypothetical return of 10% per period would require about 97 uninterrupted compounding periods to multiply capital 10,000 times. At 20%, it would still require roughly 51 periods. Period could mean a month, a quarter, or a year. Mathematics permits the calculation, but it does not guarantee that the return can be produced on that schedule. Losses also disturb the path asymmetrically. A 10% loss requires an 11.1% gain to recover. A 25% loss requires 33.3%. A 50% loss requires 100%. As the decline deepens, the recovery requirement rises faster. This is why an average return can be misleading. A gain of 50% followed by a loss of 50% does not return the account to its starting point. $10 becomes 15, then falls to $7.50. Sequence therefore matters. 2 traders may report similar average results, while ending with different amounts because gains and losses arrived in different orders and at different sizes. Compounding acts on the current balance, not on an abstract average. The path is part of the result. Regular contributions change the equation more honestly than extreme return assumptions. When the starting base is $10, Adding another $10 doubles the capital without requiring any market gain. As the account grows, the same contribution has less proportional influence, and investment performance carries more of the burden. Early in the journey, new savings may matter more than trading returns. Later, the balance can become large enough for compounding to have visible force. Time, capital, and required return can substitute for one another, but only within limits. Less starting capital demands more time or a higher return. Less time demands more capital or a higher return. When both capital and time are restricted, the required return rises sharply. The equation may still produce an answer, but that answer can describe a mathematical possibility without describing a repeatable trading process. So define the variables before admiring the destination. Choose a hypothetical house price, subtract any capital that would come from savings or other income, state the time horizon, and calculate the return the trading account would need to produce. Then test the result again with losing periods included. The gap between those two projections reveals how much the original plan depends on uninterrupted performance. But arithmetic can only describe what would be required. It cannot tell you when the market is actually offering an opportunity, and that brings us to the behavior of price itself. Price does not move because the opportunity looks attractive. It moves because available buying and selling cease to balance at the current level. One side becomes urgent, the other side withdraws, and the market must search for a price where business can continue. That search is the basic behavior beneath every chart. When buyers are willing to pay progressively higher prices, sellers can demand more. When sellers become aggressive and buyers step aside, transactions occur lower. The movement is not a judgment about value in any permanent sense. It is the market finding the next place where enough opposing interest exists. This is why the same piece of information can produce different price reactions. News that lifts one market may leave another unchanged. The difference is often the position of participants before the news arrives. If buyers are already committed and few new buyers remain, favorable information may produce little advance. If traders are poorly positioned for the information, their need to adjust can create a strong move. The event matters, but the response reveals the condition of the market. Watch the effort required to move price. Heavy activity with little progress suggests that urgent orders are meeting substantial opposition. Modest activity with rapid progress suggests that little resistance is available. Neither observation predicts the future by itself, but each tells you something about the balance of interest. Movement should be read together with the effort behind it. Time also carries information. When price spends a long period in a narrow area, the market is conducting repeated business there. Buyers and sellers may both consider that region acceptable, so neither side has enough control to force a sustained departure. As activity becomes compressed, the important clue is not that a large move must follow. It is whether the market begins doing business comfortably outside the old area. Fast movement has a different meaning. Price may travel quickly through a region because few participants are willing to trade there. Such movement can look powerful, yet its speed may reflect an absence of opposition rather than a deep commitment from one side. If price later returns, it can pass through the same region rapidly for the same reason. Empty territory offers little support merely because the chart recorded a dramatic move through it. You should also distinguish initiative from response. Initiative activity attempts to move the market into new territory. Responsive activity appears when participants judge the new price excessive and trade back toward an established area. If initiative activity keeps producing progress, control remains with the advancing side. If each attempt travels less distance and attracts a stronger response, control may be changing before the larger chart makes the change obvious. This can be observed without pretending to know the identity of every participant. Note where price slows, where it moves freely, and where repeated transactions fail to produce further progress. Compare each push with the one before it. Is distance expanding or contracting? Is the opposing response immediate or delayed? Is the market spending more time at new prices or returning quickly to familiar ones? These observations matter because your account size has no influence on any of them. $10 and $10 million face the same auction, though they cannot participate on the same scale. The chart contains no knowledge of your target, your schedule, or the price of the house. It records only where participants were willing to transact and how that willingness changed. The practical task is to replace stories with behavior. Instead of asking whether an asset should rise, examine whether upward attempts are still producing progress. Instead of declaring a price cheap, observe whether lower prices are attracting sustained buying. Instead of treating rapid movement as proof of strength, determine whether the market can continue conducting business after the rush has passed. Yet observation alone does not produce a trade. The same evidence can support several possible outcomes, and each remains uncertain. The next step is learning how to turn what the market is doing into a decision without pretending that observation has become prediction. A small account can conceal careless work because the monetary consequences appear unimportant. A missing note costs nothing today. An undocumented entry seems harmless. But when the same behavior is repeated, the trader accumulates activity without accumulating reliable knowledge. Professional habits begin by making each trade traceable. Before the session, record the instrument, the relevant market conditions, and the specific situations you are prepared to act on. This creates a reference point made before the chart begins changing. Without that reference, memory quietly reshapes the original plan to resemble whatever happened later. Preparation should be brief enough to repeat. A long ritual that is followed twice and abandoned has little value. A practical routine might include checking the trading schedule, noting events that could disturb normal activity, reviewing the markets in scope, and confirming that the platform and data are functioning. The purpose is not ceremony. It is to remove preventable surprises before money is exposed. A checklist serves a narrower function. It protects the process from omission. Pilots do not use checklists because they lack knowledge. They use them because familiar tasks are precisely where small steps are easily skipped. For trading, the checklist should contain only conditions that can be answered clearly. If an item depends on mood or vague impression, it cannot provide consistent evidence later. The trade record should capture what the account statement cannot. A statement shows time, price, quantity, and result. It does not show what you saw, what information was available, or whether the action matched the prepared conditions. Record the reason for participation in plain language, then save an image of the chart at the moment of entry. A second image after the trade preserves what developed without allowing hindsight to redraw the scene. These records become useful only when observations and interpretations are kept separate. Price traded above yesterday's high is an observation. Buyers were in control is an interpretation. If you mix the two, a mistaken conclusion can masquerade as a fact. Separating them makes review more exact because you can see whether the raw information was wrong or whether the meaning assigned to it was wrong. Review should occur on a schedule, not merely after an unpleasant result. Reviewing only when something goes wrong creates a distorted sample. Profitable trades may contain poor procedure, while losing trades may have followed the established method faithfully. A weekly or fixed session review allows you to compare like with like and identify repeated behavior across enough examples to matter. Use simple classifications. Mark whether the trade matched the prepared conditions, whether required information was recorded, and whether the action differed from the plan. Do not build a journal so elaborate that maintaining it becomes a second occupation. The record must be detailed enough to expose repetition and simple enough to survive ordinary weeks. Research time should also be separated from trading time. During research, you may test ideas, examine historical behavior, and question assumptions. During live observation, constant redesign creates moving standards. If every new price movement changes the method, the records from one trade cannot be compared with the next. Separating the two activities gives each idea a stable form before it is judged. With $10, these habits may produce more value than the account produces income. The capital becomes a controlled setting in which preparation, documentation, and review can be practiced under real conditions. The dollar result remains small, but the record begins revealing whether your work is consistent or merely active. Before the next session, create one page containing the preparation notes, the checklist, the entry record, and the review fields. Keep the format unchanged long enough for patterns to appear. What those records reveal will become especially important after an order is filled. Because the moment a position is open, procedure must continue while the market begins testing it. The position you open is rarely the position you finally close. Time changes the information, price changes the exposure, and each adjustment can alter the risk you originally accepted. A trade that began with clear limits can become a different trade entirely if management is improvised after entry. The first task is to distinguish adverse movement from invalidation. Adverse movement means price has moved against the position. Invalidation means the reason for holding it no longer stands. The two are not always the same. If every unfavorable fluctuation is treated as failure, ordinary market movement will repeatedly force an exit. If clear invalidation is dismissed as ordinary fluctuation, a defined loss can expand without limit. That distinction must come from the structure of the trade, not from a fixed amount of discomfort. Before entry, identify the price behavior that would contradict the idea. Once the position is open, compare current behavior with that condition. The question is not simply, am I losing? It is, has the market done what this position required it not to do? A protective stop gives the judgment a practical boundary. Moving it farther away increases the amount at risk and changes the original proposition. The position may remain the same size, but it is no longer the same trade. The expected opportunity was accepted under one loss condition. Widening the stop asks the account to finance a new condition without a new analysis. Adding to a position requires the same clarity. Additional size should not be used to improve the appearance of the average entry after the market has contradicted the premise. A lower average price does not repair a broken idea. It increases exposure to it. Adding can be considered only when the original thesis remains valid and the added position was allowed for in the initial risk structure. Favorable movement creates a different management problem. A trade in profit still needs room to behave. Tightening protection too quickly can turn every small pause into an exit, while never adjusting it can allow a meaningful gain to disappear. The proper response depends on what the trade was designed to capture. A short movement and a broad directional move cannot be managed by the same standard. Partial exits divide the position into separate obligations. Closing part can reduce exposure while leaving some participation if the move continues. But the remaining portion must still have a defined purpose. Otherwise, partial profit taking becomes a series of unrelated reactions that makes the final result impossible to evaluate. Time can also invalidate a trade. Some ideas depend on price responding within a particular window. If the expected movement does not appear, the absence of progress becomes information. Capital held in a stagnant position remains exposed even when the price has changed very little. A time condition can therefore be as legitimate as a price condition when it belongs to the original premise. Management should be based on new market information, not on the account's changing profit display. The unrealized number tells you the financial consequence of the movement. It does not tell you whether the position remains sound. Two identical charts deserve the same interpretation, even if one trader entered earlier and shows a profit while another entered later and shows a loss. For each position, define 4 points of control: what invalidates it, what justifies holding it, what permits reducing it, and what would support adding to it. These rules need not predict every fluctuation. They must prevent each fluctuation from creating a new policy. This is especially important with $10 because there is little room for a managed risk to become an accidental one. Yet even disciplined management cannot protect an account if the trader keeps placing positions merely to create activity. That next danger begins not inside a trade, but in the decision to take too many of them. When $10 is expected to produce a meaningful income, the account faces a problem that trading frequency cannot solve. The position is too small to create the desired dollar result under ordinary conditions, so the trader attempts to compensate by taking more positions. Activity rises, but the quality of the available opportunities does not rise with it. Markets do not produce suitable conditions on demand. There are periods when a clear advantage may appear, and periods when price offers little more than random movement. If you require a certain number of trades every day, the requirement eventually becomes stronger than the evidence. The first trades may satisfy the method. The later ones are often taken because the daily quota remains unfinished. This gradually lowers the standard for participation. A setup that once required several clear conditions is accepted with one condition missing, then two. Soon, resemblance replaces qualification. The trader is no longer selecting from the market. The trader is searching until some piece of price action can be made to fit. More trades can also create the illusion of diversification. Several positions may carry different names while depending on the same underlying movement. Two technology shares, a stock index, and a related derivative can all represent one broad exposure. If they respond to the same market force, 4 entries do not create 4 independent opportunities. They multiply one idea without making it more reliable. Time frames can hide the same duplication. A trader may open one position from a short chart and another from a longer chart, believing each is a separate basis. But if both depend on the same directional move in the same instrument, the account is still concentrated. Counting tickets is not the same as counting distinct risks. Constant participation also weakens comparison. Suppose a method is meant for a particular condition, but trades are added during unrelated conditions to keep the account active. The final results now combine several different behaviors. A strong setup can no longer be evaluated clearly because its record has been diluted by trades that never belonged to it. This produces a dangerous interpretation. When the mixed results disappoint, the trader may assume the original method needs more signals, more markets, or more activity. The attempted repair adds even greater variation to the record. The cause was not a shortage of trades. It was the inclusion of trades that had no common basis. The useful measure is therefore not how often you participated, but how often the market presented the exact condition you intended to trade. Some weeks may produce several valid instances. Others may produce none. That uneven distribution is normal. Opportunity follows market conditions, not a calendar. You can make the mistake visible by creating an opportunity budget. Define the limited types of situations that count for the current method, then mark every position that falls outside them. Also group positions by their underlying exposure rather than by ticker symbol. This reveals whether apparent variety is simply the same market opinion repeated through several instruments. Next, compare the number of qualified observations with the number of actual trades. If trading activity repeatedly exceeds qualified opportunity, the excess is not productivity. It is evidence that the account's financial target is forcing participation beyond the method's natural supply. $10 cannot be made economically larger by dividing it among more weak ideas. A small account gains its usefulness from selectivity, because selectivity keeps the evidence clean. The question then changes from, how can I trade more? To, what must I be able to demonstrate before trading larger? That is where the development of the trader begins to matter more than the movement of the account. A larger account does not create greater skill. It creates a larger consequence for whatever skill, or weakness, is already present. If the method is unclear at $10, adding capital does not clarify it. It simply makes each unclear action more expensive. Trader development should therefore be measured by what can be demonstrated, not by how long someone has watched charts. Time provides exposure, but exposure alone does not prove learning. A trader can repeat the same error for years and call it experience. Progress begins when one level of competence is established before the next level of difficulty is introduced. The first stage is observation without participation. Here, the task is to recognize a narrowly defined market condition while no position is influencing the reading. Can you identify when the condition is present, when it is absent, and when the evidence is too mixed to classify? Until those distinctions are stable, execution would only add consequences to an unfinished idea. The second stage is simulation. A simulated environment tests whether the idea can be translated into action where participation would begin, under what circumstances it would end, and whether the rules can be followed as price unfolds. Simulation cannot reproduce every feature of live trading, but it can expose vague instructions. If two identical situations produce two unrelated actions, the method is not yet precise enough to scale. The next stage uses minimal real exposure. The purpose is not meaningful income. It is to discover whether the procedure survives contact with an actual account. Real orders create constraints that simulation cannot fully reproduce, and small capital allows those constraints to be encountered with limited financial consequence. At this stage, success means faithful execution, not a dramatic return. Only after repeated compliance should performance become the main test. A few favorable outcomes prove little, because chance can reward poor work over a short sequence. Evidence requires enough occurrences to show whether the same method is being applied consistently. The sample need not be perfect, but it must be broad enough that one unusual result cannot dominate the judgment. Scaling should then occur in increments.